For today's interview, I wanted to welcome back to the show Angel Oak's Tom Hutchens to talk about the latest from the non-QM space. He's president at Angel Oak Mortgage Solutions and has more than 25 years of experience in leading sales for a wholesale and correspondent lending platform and has proven successful in expanding a lending footprint nationwide. You are, for all intents and purposes, my non-QM correspondent on this
Okay. All right.
podcast. And
Happy to be that.
it's been a little while, and so let's get a state of the industry here. And as
Yeah.
we wind toward, or I guess we're in the middle of the third quarter here,
Right.
state of the non-QM.
The mortgage industry is just still struggling to kind of really grow like we all had planned this year to be kind of a hyper growth year, honestly. We've had some things happen geopolitically that have hurt the industry and hurt real estate just as a whole with inflation and oil. We know all the reasons why. But the state of the industry, I'd say, is really in a great position. Like we've seen just over the last couple of years, so many new first-time non-QM originators that have learned that hey, these loans aren't that hard, and wow, there's lots of borrowers in my market that I have never even thought about reaching out to that I can now reach out to. So we're seeing that kind of a transformation of non-QM being a more of a fallout thought. Well, if I can't get it done this way, then maybe I can go to non-QM, which is, traditionally the non-agency volume. Well, I'm talking pre-financial crisis. That's really what it was. It was a fallout if they did someone's credit or whatever. But now it's not a credit play. It's really just their situation, their being self-employed, their income, the fact that they own a lot of investment properties and tax returns and all that get super complicated. That has really filled a void in the market that we believe this 12 years ago when we started this effort 13 years ago, that there's an opportunity. There's always non-agency borrowers. Fannie, Freddie, FHA are never going to be the right loan for everyone. Certainly the majority of the people, yes, but not everyone.
I like your outlook because some people would say, gosh, there's all these new upstarts in my field. They're taken away from me. Versus you're going, if the entire pie gets bigger, it's a good thing.
That's yes.
Inherent advantages you like having being the long-standing member of the non-QM society, Professor Emeritus, yeah,
Yeah.
as Angel Oak, advantages
Yes.
Angel Oak enjoys having been in the space for so long.
Well, we've worked really hard to build awareness of the industry, and it honestly it helps us. Yes, there's lots of competitors, but we are very confident that our experience and our processes and everything that we do is as good as it gets. So we're comfortable with that. It's okay that there used to be three or four of us doing non-QM. Now I don't even know the number. I hear new names on a weekly basis, but that's fine. I'm okay with that. I'm okay that Angel Oak is known as kind of the original non-QM lender. We were doing non-QM loans before non-QM or QM was even a designation. So, that's fine. We always have had a target on our back, and we do today. So that's good. We feel good about the people that we have, our products, our processes, that we do a great job for our broker partners.
How does the non-QM space need to evolve from here? Or where do you see it evolving to continue to push things forward?
Typically, we think in terms of products, but I don't think that I still don't think I think the products are very well positioned. There's good loans. They prove, we have a proven track record of performance, which has been the number one priority for us since we started this, because we knew following the great financial crisis, if all of a sudden we started originating bad loans that didn't perform, the lights would be turned out early. Especially in 2013, that was so close to the financial crisis. We heard a lot of people saying, "Oh, this is just subprime 2.0." And I don't know if you were in the business at subprime 1.0, Robbie, but we battled that, and we said, "No, listen, these guidelines are solid. We have skin in the game because we're securitizing these loans ourselves. Some of the Dodd-Frank regulations require us to actually own pieces of the bonds that we issue. So the formulas were put together properly to build this successfully. So I started with saying it's products, or we tend to think of products, and I don't think that. I think there's just still, this is still an untapped market. There are so many borrowers. You think about how many more people are self-employed now over the last 6 years. COVID created a lot of self-employed borrowers because companies said, hey, why don't we just contract with you instead of employ you? And we don't need office space for people anymore because they can work remote. And there's just reason after reason why this non-agency borrower base continues to grow.
Are there still misconceptions about non-QM out there, either from borrowers or companies that are on the fence and skeptical? Anything worth dispelling here in 2026?
There's always a misconception that they're difficult loans to close because they're not agency. The originators and processors and the agency side, they're just used to hitting a button and getting an approval and what they have to provide to close the loan. So non-QM is a little bit more manual than that, but the misconception is that they're hard loans to close. But we've done, and the industry has done a really nice job of getting technologies in places where the process is bulky. The easiest example, Robbie, is calculating income from bank statements. When we started this many, many years ago, we had to do it manually. We were reading PDFs of bank statements and on an Excel sheet, adding up all the deposits and taking out the deposits we couldn't use. And it was a long, tedious process. But now we have automation, and we can get income calculated within minutes, and that's the income that we're going to use for the loan. There's no surprises, and that goes a long way. So I think that's, again, the misconception would be, wow, I want to do non-QM, but I don't know anything about it, and it's probably too hard for me to learn, and so I'm not going to do it. But again, that's what's really changed in the last couple of years. So many first-time originators have dipped their toes in the water and realized, hey, the water's warm. This is nice.
Yeah. When we think about bank statement, loans, DSCR, closed-end seconds, asset qualifier, like where are you seeing the most expansion? What products are seeing the most growth currently?
Our bank statement HELOCs have been a real hit for us and for the market because we still haven't gotten out of the period where people are locked into these super low first lien rates, and they've seen equity in their properties grow tremendously since COVID, but they don't want to get rid of that 4% rate. And they already have a non-QM, a bank statement loan, but now they can tap into that with a HELOC or a closed-end second. And that's a new product. That's a new product over the last 24 months. So that's where we've seen growth. And I think we're going to continue to see that until first lien rates really kind of find their footing at a little lower level where it makes more sense to refinance into a first lien and tap into that equity. But right now, the numbers still are better. Generally, use a closed-end second or a HELOC.
Thoughts on volumes for the year? I think I saw at the beginning, when Redwood Trust did their first securitization, there was something they had predicted about $85 billion in securitizations this year. Overall origination volume in the non-QM space between 150 and $200 billion. What are we tracking for this year?
I think those numbers are actually still pretty accurate, Robbie. Yeah, it's again, the business has been tough. The business hasn't really hit a growth spurt, but non-QM continues to grow because of all the things that we've just talked about. More and more people are tapping into that market, and the difference now is that most originators, they see non-QM as almost a lead-in product. It's something that they can talk about with the referral partners. Hey, it's something new. It's something new to talk about versus, hey, I hope they can fit into Fannie Mae, or it's just because the real estate agents, they keep themselves educated on what kind of loans are out there. And so when they hear about something new, certainly they know self-employed borrowers that have nice houses and have talked to them about wanting to move, but thinking that there was no financing available. So it's a great talking point even to open doors for originators.
What have we seen in terms of rate movement with more demand in the secondary markets? Just how much has that allowed the kind of the lid to come down?
Well, the credit spreads have definitely tightened over the years. So that speaks to demand. It speaks to performance, which I already mentioned. Those when people see that these are good loans, and there is just a lot of capital. Investors love U.S. real estate. They just do. It's a very secure investment, relatively safe investment, and at the loan to values and the credit profile of these borrowers, it's very safe. So as those spreads continue to shrink, the rates go down as well. Now, what we need though are the treasuries to come down. That's what's really been kind of keeping the rates elevated. So
Where,
as soon as those
where,
treasuries,
where are
sorry,
we on top of agency rates roughly with some of these products?
I would say so. Non-QM is primarily based on the 2-year treasury versus the 10-year. It's a little bit higher than normal, but I'd say the spread is anywhere from 100 basis points to 150 basis points in that range
Cool.
for the consumer.
Tom, always a pleasure. Let me be the
Yes.
first to wish you happy birthday, and
Thank you, Robbie.
hopefully we'll do this again soon.
I look forward to it. Thanks so much.